Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, August 29, 2018, looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. If it's not obvious by now, it should be obvious to everybody. We are in a melt-up. This is the vacuum. We started discussing a vacuum probably maybe 4 or 5 weeks ago, 3 or 4 weeks ago, something like that. All the videos are public. They're all posted on this channel. We began talking about this very scenario, and here we are in the middle of the melt-up. And the question is, where does the melt-up end? Where is it over, and or when is it over? And here's what I'll say. Number one is, don't try and guess where the top is. You're likely to be wrong more than you're going to be right. And here's something that I've mentioned time and time again. Markets can always go a lot higher or a lot lower if they're on their way down than people think they can or people realize they can. It happened in the deep decline of 2008 into early 2009, into March 2009. The market went significantly lower than anybody ever thought that it could. Certainly when having those discussions near the former highs, and the same goes true here. At those lows in March of 2009, which is quite some time ago, coming up on a decade removed, but the market went from 666 in the S&P to today's price of 2,914 in the cash index, $291.48 closing price on the SPY from a low of around $66 9 years ago. So just to put things in a little bit of perspective, can we push a little higher? Yeah, I think there's a little bit of room left. And we'll get to all that in a minute. Let me pause here and just thank everybody once again for participating, making comments and posts underneath the video each and every night. I appreciate the participation. A lot of the comments have important and informative information. There are questions asked. I'm a participant. I'm going to answer questions. So you never know what you're going to find under some of these videos. You'd be surprised at some of the information that's actually given under these videos. So don't discount it. Go through it and make a post or two, see what happens, ask a question. I'll certainly take a look at it and I'll provide an answer. In addition, please hit the like button and share the video with those people you think can benefit from this information. All right, so let's get back to the market. So let's just call it what it is. It's a melt-up. We were calling it a vacuum a few weeks ago, saying a vacuum was coming. Here it is. There are higher prices coming. This is not it. Today is not the end. We are extended. We can stay extended. We're obviously extended from home base. The market doesn't necessarily love to get too far for too long away from home base. So we will have some down days. But this market has higher prices coming. Today is not the last day of the rally. We'll know it when we see it. There'll be a very, very well-signaled reversal at hand when the market's ready to reverse trend. Like anything else, it will start out as a small signal, and over some period of time, that piece of information will morph into what we know to be a reversal of trend, and we'll be able to be a participant in that trade with limited risk because we will have known at the time where wrong is. And that's the name of the game. There's nothing that says the market can't go up again another 10 or 15 handles. The S&P 500 was up 16.5 points today. What's to say it can't go up another 10 tomorrow? Will it? I don't know. Is it likely? It's unlikely. However, you don't know where the top is until the market tells you here's the top. What are the identifiers? They're taught in my course at lazyeMinitrader.com. Is there anything really to discuss further on the SPY chart? higher prices are likely. Do they have to happen tomorrow? Not necessarily. Are we going to get very, very light volume floating into the 3-day holiday weekend, the Labor Day holiday weekend here in the U.S. this coming weekend? Yeah, likely, and the path of least resistance in light volume is typically to the upside, so I wouldn't be surprised to see higher prices. What would be the next target on the upside in the spider? Well, 292, 292.50. It's hard to say. You're just going to have to take it in 50-cent chunks from this point forward. There's no alternative. There may be some numbers that become clear. We may run all the way to 295 before this is over. We may run higher. We may get more of an idea as time goes on. But what I can tell you right now is it's not on heavy volume, and that means something. Now, the volume wasn't terrible today. Okay, it was better than it was over the last several days, but we're not getting heavy institutional buying into this upswing, meaning much, much higher prices are coming and for a very long time with institutional money parked there for a while. That's not necessarily the type of buying, but that doesn't necessarily tell you how high price may or may not go. It's just signaling to me that it's not going to be, for example, the start or the beginning leg of a multi-leg bull rally. We've already had a multi-leg, multi-year bull rally. It's going to come to a close, and we just have to be on the lookout for where and when that takes place. And the market will tell us where and when that will take place. For now, you let price rise. If you're long stocks, if you're long the spider, if you're long the Qs, if you're long another index, you just keep riding it higher until you get the reversal. So there's not much else to talk about in the spider right now, but what we can do, and we will run through the other markets, what I also want to do is I want to talk about 3 stocks in particular, but they come with stories. The stories have charts attached to them. The charts have technical analysis attached to them. And I think it would just be a good exercise. Again, it's not only really getting into my head, which, as we know, is a dangerous place to be, but it's also getting into a couple of conversations, but they're all for the greater good. It's all for the learning experience of the data. So we'll do that, but first let's run through, for example, the IWM. So the IWM still, and this is interesting, again, this is a puzzle piece that stays on the table. We've yet to close, and think about it. The SPY was up big today, right, relative to already being at a closing high and an all-time high. And so the IWM, not at a closing high, we still have that pseudo doji candle from a couple of days ago, that somewhat of a tail candle, pseudo doji candle, that any trader could be short, could have been short against any daily close above that tail or that pseudo doji candle from the other day, the 27th, then you're out of the trade. The loss would be small and fast, but nevertheless, that trade, interestingly enough, is still active, and we're not making new highs in the IWM. So that's definitely important and interesting information. It's a puzzle piece. It's on the table. Other than that, the IWM underperformed the spider today. So the spider was up a little more than 0.5%, and the IWM was up a little less than that. So not all that much, not a big enough deal to make a big deal out of it. So we'll just move it along. So next thing is we'll take a look at the VIX. And so we had another up day in the market, and the VIX finished flat. So we had a 0.5% up day in the S&P. We had the NASDAQ up 1%, the NASDAQ composite up very big today. And the VIX, interesting that this pattern is still kind of telling us that there may be one more move up ahead of us in the upward or higher direction, I should say. And that will remain the case until and unless we get a close below this low right here. And so that's what I'll say. It's interesting to watch. People still buying protection. There was one point today, the VIX was up, the VIX was down a little bit. The VIX finished flat. The short-term VIX was up. The longer-term VIX was down at one point. It was just interesting information to watch. You know, I can make a case also that there's a bearish pattern brewing here. Certainly, we're below all the moving averages. So I can certainly make a case that we have lower to go. And then once we break below and close below this level, they'll want to fill the gap down here. And once filling the gap down here, a decision would be made whether we bounce higher or continue lower. That's at the point in which stock prices are certainly continuing higher. However, right now we have stock prices continuing higher and we do not have the breakdown in the VIX. So that's a puzzle piece. It's on the table. Transports up 5 points. Not a big deal. So not really pacing the S&P 500. That's interesting. Struggling to get through that double top area that was made just a few days ago. That's interesting. Why not make a new high along with the S&P? Is that telling us something? The IWM, my number one favorite market leading indicator, and the transports, my number two favorite market leading indicator, are interesting when we look at the charts. They're really not confirming the new highs that the S&P 500 is making. So one conclusion from that is either these two markets will catch up on the upside or the S&P is going to pull back a little bit, come back toward home base, and work off some of this short-term overbought condition that exists. The Qs. I mean, what do you say about the Qs up $2.24, 1.21%, just an absolute, bar none, without a shadow of a doubt, powerhouse. Look at this uptrend, grip hold on the market to the upside. It's extended just like everything else we just talked about, but it's just a tremendous move, and it's really in part by three in particular stocks. Amazon, which is really at, and you have to see this, it's at 2,000. I think it hit 2,000 in the aftermarket hours here, aftermarket session. Let me just see real quick, because I think it printed 2,000, $1,999.98. So it's likely going to print $2,000. When we go back to the daily chart, you'll see here that Amazon, for some reason, was up 3.4%, $65.93. I mean, just an unbelievable move in Amazon. It's a melt up in the S&P. It's a melt up in Amazon. It's a melt up in Apple, up $3.70. Not so much in Facebook was down, but Google was up $15 today, not at new highs. We have to note that. That's a puzzle piece on the table. But I just wanted to bring it to your attention, along with the NASDAQ, along with Amazon and Google and Apple, and that's part of the reason why we see the exorbitant move in the triple Qs. Again, we've been here before. This is a melt up. We've read this book. We've been to this movie. They come to an end. We just don't want to guess when they're coming to an end. XLF today didn't do anything. No story change from last night. No story change from the night before. So we'll just leave it alone and we'll move it along. In fact, now is a good time to talk about those three story stocks, if you will, today. So the first one we'll take a look at is Dick's. And so here's a daily chart, and you see two horizontal lines on the screen. The first one, or the higher one, 34.97, that comes into play from an intraday perspective. I'll get to that in a moment. The first one, or the lower one, 31.44, that comes into play because it was one of the possibilities from a morning gap trade perspective this morning. But here's the point I want to make, at least from this perspective right now on the daily chart of Dick's. Sometimes we get a great trade out of one of the morning gap trades. Sometimes a stock doesn't reach our level, but the stock is in play that day. So we want to make sure that we keep an eye on it. We're looking for opportunities. We're traders. That's what we do. We need to know where to find opportunities. I'm giving you an idea of where to find opportunities. There are plenty of people in here. There are plenty of traders in here watching this video that trade the morning gaps right alongside me. So I'm giving you an opportunity or an idea of where to find additional opportunities for trades during the day. So here we go. Morning gap trading opportunity, DIX is in play. It doesn't hit the morning gap trading opportunity or level, price level, 31.44. That's the target, and it just takes off to the upside, right? So it finds support right around the daily 200 period moving average. I wasn't willing to buy that level. Those of you that have taken the course at Lazy Gap Trader understand where these price levels come from, where 31.44 comes from. So that's the price. That was the high probability trade for me. Didn't happen, and therefore took off to the upside. Nothing happened. So you go down to an intraday, and I keep watching it during the day. Let me get back to the regular time frame here, regular session. So here we go. So the stock finds a low. Here's the gap down from yesterday, and the stock just powers higher all day. What does it do? It fills the gap that it left open from yesterday, basically to the T, and then pulls back. So that's trade number one. Any trader that has taken either of my courses know that was trade number one. Trade number two comes about an hour later at $34.97. Why is that a long trade at that price at that time? There are three reasons on the chart why that trade is a long trade at that price at that time. Any trader that has taken my course at Lazy E-mini Trader can tell me why, has taken a trade like that, should take a trade like that, or will take a trade like that, or did take this trade. It was right there in front of us in red and green. And guess what? In about 30 minutes time, it gives about an 80-cent rally off that price level of $34.97, never really taking much heat on the trade, not really out of the money by much at any given time, just a few pennies, as you can see. It was a nice afternoon day trade. It's what we call an afternoon delight. And so that's pretty much the whole story with DIX in a nutshell. So the second one we'll take a look at is AEO, American Eagle Outfitters. And the reason why I wanted to show you this one was this was one of the morning gap trades. What a tremendous trade. If you don't know the morning gap trading strategy, you're doing yourself a disservice by not learning the strategy. And I'm not suggesting that every trade looks like this. That's not what I'm saying at all. They don't. But a lot look like this, and those that have taken the course can attest to that. But here's the deal. So American Eagle Outfitters closes yesterday at $27.27. It opens today. It's getting crushed at the open. It's down at $23.67. That's what? Somewhere in the neighborhood of, 13, 14, 15%, something like that. That was the level that's taught how to be calculated in the course at lazygaptrader.com. It makes a low at $23.66, as you can see here, and just takes off to the upside. Now, you need to learn the strategy. I'm not the only trader that knew that that price level was important. There was a flood of orders on the buy side that came into the market at AEO at that price at that time and kept buying it higher all afternoon long. There's a reason why you can learn how to calculate these specific price levels in the course at lazygaptrader.com. And they're also taught how to be calculated in LazyEMiniTrader.com, but in a slightly different manner, using that strategy or technique a slightly different way. These morning gaps are a little bit special. Well, anyway, that's why I wanted to show you AEO. Look at that trade. Tremendous, unbelievable trade. Now, every trader got a different amount of profit out of that trade. Who knows how much any one trader got? As you know, what I advocate to do is at some point in time, you book some profit along the way, and you let the rest ride in a risk-free, emotionless way. And so you see how high you can ride the stock. Eventually, you'll be stopped out, or the day comes to a close, or you close it out for whatever your reason is. These are the ones. These are the home run trades where you want to have a piece of the pie. You want to be a participant up for 8% in a couple of hours. Now, the next one I want to talk about is from a slightly different angle, but I think it's good from an educational perspective. It's Gilead. And it's not really the chart so much that I want to talk about. It's really the psychology behind the trade that I want to talk about. One of our traders, one of our members, brought this chart to my attention yesterday. And please understand, I'm not singling anyone out. There's no names. I'm using the information and what happened as an educational and learning experience for everybody else. It's for everybody's benefit. So this is all for a positive because we've all been exactly in this scenario before. Here's what happened. Trader comes to me with a chart at Gilead with the setup. Right out of the course at Lazy E-mini Trader, he's right. There is a setup on the daily chart. Anybody that's taken the course that understands the techniques, understands what a setup looks like, is salivating looking at this chart yesterday. The setup for a short trade is right there, and it's flashing, take me. So the trade to be taken from a daily chart perspective was correct. Cannot fault the trader for taking the trade. Now here's what happened, and this is where the story unfolds, and it goes in a couple of different directions because we've all been here. If anybody has taken my course, they understand where wrong is on this trade. The objective is to be wrong small and fast if we have to be wrong at all. And the truth be told, we're going to be wrong. Even the best trade setups end up not working out sometimes. That's just the way it works. There's nothing we can do about that. So here's a setup that was flashing, good setup, good setup, good setup. There really isn't much of a reason, at least on the daily chart, not to take the trade. Can't fault the trader. Today rolls around and you can see Gilead is up. It's up nicely, and you can see where it's going to close, and you can see as the day progresses, you can see it looks like it's going to close or possibly can close where it would be wrong from a trading perspective on the short side, expecting a bearish pattern to play out. Trader comes to me and says, what do you suggest? Now, I'm not giving any trading information or advice. And that's specifically that's the first thing I tell everybody. I'm not giving and I'm not here to give anybody advice. Here's what I see. And the first thing he said was, there looks like there's more resistance up, and he gives me another number. And he was right. There should be more resistance up at that number. But what I reminded the trader was, did the reason you took the trade change? Did the bearish pattern all of a sudden become not active any longer because price closed on the daily chart above a certain number? And the answer becomes obvious. You stop out of the trade today, this afternoon, the loss is extremely small from a percentage standpoint. I think the loss is somewhere around 1%. It could be slightly under 1%. It could be slightly over 1%. I don't know where the entry was. But that's it. It's small. It was in one day. It's fast. You move on to the next trade. But here's the other thing that I pointed out to said trader. And when I look at the daily chart, I could see there's some kind of consolidation going on that might be better seen or viewed from a larger perspective, namely the weekly chart. So I go to the weekly chart and I say, hey, well, I can make a couple of different cases a couple of different ways just looking at this chart. So let me just start to think about it and look for a minute and see what we have. And the first thing that my eye gets drawn to is we closed above that breakdown candle. That's a positive. That's item number one. We've read that book before. We've seen that happen on other charts before, and we've seen the result of that on other charts before, haven't we? And then I say to myself, also, what does this look like? This looks like a potential A, meaning A up, B pullback, and a C in an ABC pattern completing officially, or technically speaking, above the high of the A leg. That's also what I see in the bullish case. We're into the 50-period moving average on the weekly chart. That could be some resistance, and therefore that builds the case or helps support the case that there could have and normally should have been some resistance where there was on the daily chart. But here's the other thing. Also on the weekly chart, there's a big breakdown candle here on the weekly chart, and we could also be building a bearish pattern to go down for another leg to the downside and potentially want to test the low of this breakup candle at some point in time down near around $70. That's also a possibility. That would be on the bearish side of the equation. You have to look at both sides of the page. But in terms of the trade, when I look at the daily chart, I say to myself, hey, the reason I took the trade is off the table. I'm out of the trade. I have to take a loss, but it's small and fast. I look at the weekly chart, and I have a couple of reasons why. The weekly chart, I can make pretty good case. It's bullish. We're in a bullish market. The market is melting up from an index perspective. Why do I want to be short anything when the major market is melting up? Yeah, it'll turn at some point, but I don't want to fight the market. I don't want to be that guy on the other side of the crap table betting on the don't pass line, hoping everybody else craps out. I just assume not be in a short trade overall when the market is melting up like it is. To me, that's just the easier thing to do. I'd rather look for buying opportunities if there are any. But that said, at the same time, there was absolutely nothing wrong with that trade setup whatsoever. It just was one of the ones that it just didn't work. All right, so we're back in our lane here. We'll take a look at gold. I just thought it was interesting. 3 different stocks, 3 different charts, 3 different things going on. Just trying to mix it up a little bit as the market melts up and give you at least some kind of different perspective of what goes on throughout the day. So looking at the gold chart, again, above the 20-period moving average, fantastic. We're still really in a downtrend for the most part. We had a big up day. Can there be more upside? Yes. Do we probably need to kind of back and fill some more, consolidate a little more? That would be my vote. I wouldn't necessarily think we're going to take off to the upside just yet. I mean, if we look, for example, let's look at the 60-minute chart. I'll give you this for argument's sake. So when you look at the 60-minute chart, what does this look like? Right? We have a down move. We have a long bearish flag pattern for the most part, right up into the 50-period moving average. Looks like it wants to break to the downside. That would be the normal reaction off of a setup like that. We have a daily chart that I can make a case one way or the other. I can make a case we'll fall back to the 20-period moving average, or I can make a case that we're going to pop a little bit higher and eventually get through this consolidation point or area. And the question is, when does each one happen? And I can't answer that, and that's why there's no trade here. There's no setup to put capital at work on the gold chart as far as I'm concerned. So we'll just move it along and go over to crude oil. And what do we find here? In crude oil, we find the beginnings of a breakup or breakout. So here's what happened. So we closed above this high right here, 68.79. We talked about it a couple of times. Closed above it is a positive. Well, let me back up. I think maybe we closed above it one time, but that's enough. It's a shot across the bow. We just talked about it in another market. We talk about it all the time. It's a good way to see the market kind of tipping its hand a little bit that higher prices are likely. And you can see what happened. And you already had indications being above all the moving averages, fighting the high of that breakdown candle. We closed above it. We've seen that book before or read that book before. We've seen that movie before. You begin to start believing in the same patterns that repeat over and over and over again. And when you see the same things repeat over and over again, you start to understand that all charts act and react the same way. So now we're going to probably go up to $70. That's the natural next area. It's not that far away from where we are as I make this video, or what was our high so far, 69.76. We'll get to $70, and then we'll get to challenge eventually 72.60, give or take. We'll get to challenge that breakdown candle high. And that gets us back up into near the hot zone, and maybe we get back deeper into the hot zone. Maybe we don't. We'll know more about it as we approach, but right now it's bullish. Higher prices are likely. The trend for now on a shorter term basis is higher. With that, folks, I am out of wind. I'm going to wrap it here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.